G'day folks, I've been asked to reveal a couple of indicators I've introduced recently, and these are the multiple moving average on the price chart and multiple moving averages on the commodity channel index. So here we go. So this is the finished product. I've got the price chart up here with the multiple moving averages of the price chart and the multiple moving averages on this second chart on the CCI150. Now before I get stuck into those, I want to just emphasize as well, there is another indicator I'm using in my daily updates, and this is and I've titled it Pete's Multiple Indicator. I know it's a fancy name, but that's in the description in the video link below and all my other videos as well. So if you want to understand how this works, reference that video and watch it. Now, so I'm not going to cover that today. We're going to remove that out of today's video, but we're going to keep that in the links for your benefit in the description of each of the videos I post. Now these little arrows, the blue arrows and the red arrows, as you can see on the price chart, that's simply reflecting what this Pete's multiple indicator is showing. So if it breaks higher than, you can see here on this particular indicator, there's a zero line, 1, 2, 3, 4, and it goes up to 6 or 5 actually. So if it actually breaks higher than 2, then it draws on this point here, it draws a blue arrow, meaning there's a chance of it rising, the price rising. Or if it breaks below the -3 line, it shows the price possibly declining. So again, that's what those arrows indicate on the price chart. So I'm not going to cover that today. So what we'll do, I'm going to minimize that, and I'm just going to talk about these two indicators today. So first off, I want to, before I jump into the code, if you like, or how these are defined in the chart, you'll notice there's multiple moving averages here, and there's also this other pink line, and that's an exponential moving average 9 on the close. And I'll explain what that is in a minute. So let me first talk about the first indicator on the price chart. That's the multiple moving average indicator on the price chart, and there's 6 simple moving averages with the 20 period on the close. So each of these, the first moving average is not offset, so it's a default simple moving average 20. The second moving average is offset by 1 bar, third 2 bars, the fourth 3 bars, fifth 4 bars, and the sixth moving average is offset by 5 bars. And I've coloured the first moving average with no offset with a blue colour, and the sixth moving average, which offset by 5 bars, as a colour red. Lastly, we've got one exponential moving average with a 9 period on the close. As I said, that's the pink line. So on the price chart, there are those 6 multiple moving averages offset by 1 each. So this is the 0 offset, the blue line. That's offset by 1, 2, 3, 4, offset 5, set 5, which is 6 moving averages. And the 6th line, the pink line, is simply used as a trailing stop loss. So for example, and I'll explain how a potential trade may go. So when the trade goes long in this case, you would close it out when you close out the trade when the close breaks below that exponential moving 9. That's the reason for the pink line. So now we'll jump to the multiple moving averages of the CCI. So here's the second indicator, multiple moving averages on the commodity channel index. So there are 7 moving averages. The first one is not offset, and that's simply a simple moving average 8 period on the CCI150. The second simple moving average is offset by 1, 3 is offset by 2 bars, 4 is offset by 3, 5 is offset by 4, 6 is offset by 5, and 7 is offset by 6. And again, I use the 0 offset as a coloured blue and the 6 bar offset as a colour red. So here this thin black line is the CCI150, and then I've offset those moving averages off that CCI150. So you can see there that's the 0 offset, the blue line, subsequently down to the offset 7 or offset 6 for moving average 7 as a red line. Now the way you would use this, as I explained in my videos, when the CCI breaks, when these waves or these moving averages break to the upside, like you see there, it's breaking above there, at that point there, Subsequently, you want to see the blue line. That's why I've got the blue and the red. So when the blue crosses over the red, as it does there, then you wait until the price moving averages, the blue crosses over the red on that one. So ideally you would probably load it, you probably go long, maybe on that green bar there. And like I said, you go long there and you close it out when the close breaks below the pink. So you close it out when the close of that bar closes below that pink line. That's a trade. Now obviously it's not 100% perfect, but that's one idea in terms of trading. I like to use the divergence especially, and that's why I've included this divergence. This is the S&P 500, by the way. I've included the divergence as an example. So when the divergence shows this, preferably when you see the divergence, you don't go long, you hang on. So you could have possibly traded that point there as well if you saw that trade above the moving averages, and you would have closed it out possibly there. But again, you're taking a bit of a risk because the CCI is dropping off, and that's a sign that eventually the price will drop off as well. And if you follow my daily videos, you'll know that this currently, as of today's date, the 21st of February 2024, we're hitting this resistance at 50.49 on the S&P 500, and we may see it break to the downside. Now you'll notice the CCI is broken below, and the moving averages are broken below, which means the red line is above the blue. But notice the price chart is still rising, and the moving averages are still bullish. So you want to wait for that the price chart as well to turn down like it did back here. So this would have been another example of a bearish divergence. You can see there that those moving averages are weaving in and out, and it finally breaks to the downside. The price breaks to the downside as well. When a price breaks below the red line like it did there, that's already bearish. You go short on that bearish candle. Go short, and you probably would have closed it out on that little bar there. Now that might have been a break even. Go short again when it breaks again, as long as the parameters are still there. Go short, and again, that probably would have been a somewhat risky trade. That's why I say trade with a longer time period. So you would have traded predominantly with the on the weekly if you're going to trade the daily. Anyway, just an idea in terms of how to trade using these CCI 150 moving averages when to get in and out, using the combination of the divergence, but also with these arrows. So where you see red arrows like this, it indicates eventually the price is going to turn down. Notice if I zoom out those red arrows, and again I don't want to repeat too much of that previous video, but on the bottoms here, it's pick the bottoms, or close to the bottoms. These are pick the tops, and then here it sort of struggled with it. It was sort of going sideways. The price kept rising, it didn't pick the bottom, kept rising, it thought about it as well, kept rising, and you saw a divergence here. That's where you'd go short and eventually hit your target level there. So again, here are the two indicator parameters, and you can just feel free to pause the video. This is indicator 1 on the price chart with the multiple moving averages. And then we've got indicator 2 on the CCI 150, which shows the offset by how many bars. So again, feel free to try those out if you want to choose that as an idea of following indicators, but that's the indicators I'll be using in my videos. Hope you got value out of the video. Hit that like and subscribe button, hit that notification bell. Thanks for watching, and see you in a future video.